Good evening, everyone, and a warm welcome to all the viewers to this webinar held by EAC on Recent Opinions under Ind AS framework. I am Parul Gupta, Secretary to Expert Advisory Committee, and I am joined by CA Dr. Debashish Mitra ji, who is Chairman, Expert Advisory Committee and immediate past President, and our eminent speakers, Dr. Avinash Chandra, CA Archana Bhutani, and CA Raghavendra Goyalji, and also our Joint Director of Technical Directorate, CA SN Gupta ji. Now, I would request Chairman EAC to express opening remarks. Thank you.
Thank you very much, Parulji, the Secretary of the Expert Advisory Committee. To all the three speakers, Mr. Goyal, Dr. Avinash Chandra, Archana Bhutani, Mr. SN Gupta, ladies and gentlemen, a very, very good evening to all of you. And a hearty welcome on behalf of the Expert Advisory Committee to this second seminar of the year that we are having on expert opinions, advisory opinions that we give. Over the period of time, the Expert Advisory Committee, has been not so much known for the good work that it does. And let me tell you, this committee was formed long back, 1975, December 1975 it was formed. And the first opinion was given on December 31st, 1975. Since then, we have come a long way. We have given more than 1,600 opinions. And let me tell you, I have served earlier. When I came into the council in 2016, I served as the vice chairman of this committee. Subsequently, now having having become the president of the institute, now immediate past president, I'm serving as the chairman of the committee. And let me tell you how much I am in awe of the good work that this committee does. Some of the toughest questions are posed before the committee. Questions for which maybe CAG doesn't have an answer. Maybe other regulators do not have an answer. Maybe the corporates which are asking this question, they don't have an answer. And they expect that this committee to give an opinion. And as we all know, we have got this compendium of opinions, 42 volumes of that. But we have, with the technology changing, you can now use the search engine to get get the kind of subjects on which you want to have an opinion. What we are doing now is, we are, in every month in the webinar that we have, we are taking 6 topics, 6 cases. We are having one moderator. For example, today's moderator is CA Dr. Raghavendra Goyal, and we are having 2 very eminent panelists, right? And then today the eminent panelists are Dr. Avinash Chandra and Archana Bhutani. Dr. Avinash Chandra, many of you would be knowing, who have been associated in the institute. He was former the technical director of the institute. And today when we discuss various matters in the Expert Advisory Committee, I personally look towards him for his opinion, and he really gives us a viewpoint which sometimes we have not thought about. Archana Bhutani, I have seen her being associated with the council for a long time. Her knowledge on the subject of accounts is very strong. Mr. Goyal, Dr. Goyal, I met him for the first time this time when I came into the committee, but let me tell you, he's impressed all of us with his deep insights. So, you have 3 important people who are there. They'll be further, elaborately introduced by Mr. SN Gupta when he speaks, right? So, but today we have taken 6 issues. And on all these issues, mind you, ladies and gentlemen, those of us are seeing this webinar, I believe there must have been huge deliverables. Because when we take up issues now, and some of the biggest companies are, they send issues to us, we look at the ramifications of the opinion that we give, because we are aware that the opinions that we give will have huge impact on the corporate sector. Today, unlike in 2015, today in 2023, post introduction of Ind AS, most of the opinions they relate to, or most of the issues they relate to Ind AS. And we just had the 250th meeting of the expert advisory committee in the month of July in Bombay, and then a PPT was being presented which showed that in recent times most of the queries they relate to Ind AS. And you might wonder, those of us who are listening to me, that who are these people who sit down and brainstorm and give opinions on these very intricate matters? Let me tell you, the members of this committee, the special invitees in this committee, the co-opted members of this committee are some of the best brains in the country on accounts and audit. And when we discuss at length. And even a person like me, I have to also dig into, read books and dig into all the kind of issues that I had faced when I was younger, and then be updated and understand what the committee members are talking about. And let me tell you, just like me, I'm sure those of us who are attending this webinar, it will be a great learning experience for all of you. You see, I'm very happy, very proud to chair this very important committee of the Institute. And I'm sure post this webinar, you will also feel that this committee has done great work. Today, we are having 6 issues which are being discussed. The issue of moderator will be Dr. Goel, and the 2 speakers, the 2 panelists will be discussing these 6 issues. Do listen to the facts of the case, the queries, and the opinions. And you will find, if you enjoy the intricacies involved, then we will feel that our objective of having this kind of webinars has been fulfilled. We hope to have more webinars. Now it is only once in a month. We hope to have more webinars as we go ahead. I wish all of you a very happy and enjoyable learning experience. Once again, welcome all of you to this webinar. And I would now request Mr. S.N. Gupta to kindly introduce all the 3 speakers. Mr. Gupta, please.
Thank you, Chairman, sir. And today, sir, as I'm also very happy to introduce such a legend of the institutions. I think they themselves is an institution in their own field. So, Dr. Chandra, Dr. Avinash Chandra ji, Madam Archana Bhutani ji, Goel sir, I don't think they need any formal introduction. They are the subject matter expert for decades. Dr. Avinash Chandra ji is a former technical director of ICI for a very long time, very long time. He was Secretary of Accounting Standard Board for a very long time. Dr. Avinash Chandra ji at present is a member of International Taxonomy Consultative Group of IFRS Foundation. He is also a special invitee in Expert Advisory Committee itself. He is also contributing a lot in many ways in Accounting Standard Board, Committee on Public Finance. He is advisor on many government platforms like Gazap and all. So what to add, sir? There's a huge list actually. So Dr. Avinash Chandra ji is an eminent speaker, and the kind of contribution he has made to the profession is incredible, nothing less than incredible. So I'm very happy that I'm also witnessing such a webinar where Dr. Chandra ji will be participating as a panelist for us. Madam Archana Bhutani ji is also once again a very prominent speaker and a subject matter expert. She carries more than 2 decades of vast experience of finance, of all the facets of finance actually, accounting, auditing, you name anything. She's prolific, contributor in various technical committees of the ICI. She holds a vast experience on IFRS, especially IFRS, her Ind AS, the grip over Ind AS. And we always, it's a real pleasure listening to her. The way she contributes on so many technical matters is incredible. Today's moderator and our third speaker for the day, Mr. Goyal, Raghuvinder Goyal ji. He's an eminent chartered accountant. He represents a leading chartered accountancy firms. He has a vast experience of central statutory audit of banks and listed entities. At present, Mr. Goyal is a special invitee in the Expert Advisory Committee of ICI. I welcome all of you, sir, and it's a real pleasure. I hope today's participants are really lucky to have such a galaxy of panelists, and it will be a huge opportunity for all of us to have a great learning. And the kind of topics we have selected today, sir, in the recent EAC opinion, I don't think we could have a better panel than this. So with this word, I think I hand over the floor to our moderator, Sri Raghavendra Goyal. Over to you, sir.
Thank you, Gupta sir. At the outset, I would like to begin with that knowledge is one thing which increases with the increased distribution of it. And for the same, I would like to really thank our immediate past president and chairman of this committee, Devashish Mitra sir, who has taken all the efforts to disseminate the various EAC opinions which has been circulated by the committee to the various corporates, so that the knowledge level and the general awareness level in all the members be that in practice or at service be increased, so that the quality of reporting can increase. Now, going with the webinar is structured in such a way that I would be reading the facts of the case. And then, as Gupta ji has introduced our very eminent panelists, Mr. Avinash Chandra ji and Madam Archana Bhutani ji, they would be dwelling upon the facts which were presented to the committee, and in light with the relevant Ind AS, they would spell out the opinion which was given in the instant case. In case any of the participants has any query or any questions on that, you are free to comment that in the comment box. Once the query would be completed, then we'll take up those questions of yours if they pertain to the queries. And thereafter, in case there are other more questions, that can be separately replied by the committee to your mail IDs. Now, moving on, we would go to first opinion of ours, which is regarding the timing of capitalization of transmission lines and substations as an item of property, plant and equipment from capital work in progress, and also in case of modernization work. So this is one of a very important relevant topic which was referred to the EAC of ICAI, wherein from CWIP to capitalization was discussed. So I'll briefly go through the facts of the case. This company is engaged in transmission of power in a state. I think this facts of the case are also visible to you on your screens. Substations and transmission lines are the major constituents of property, plant and equipment of the company. Work of construction of these substations and lines are being carried out through turnkey contracts. The process of construction and renovation and modernization involves multiple steps, including testing, inspection, approval from chief electorate expert to government, connectivity, commissioning, etc. Now you would see on your screen, there is a chart which has been given to us, wherein it is shown what is the typical process which is followed in the entire process. Now, what was the issue involved? Issue involved was the repair and modernization work is under progress. Majority of the equipments are installed and connected to incoming source line, but the work in respect of outgoing line is not completed due to non-availability of line clearance, and completion of the work is getting delayed. Therefore, company did not capitalize these as PPE. What was the contention of the auditors? Contention of the auditors said that approval of CEIG, which is a regulatory body to this companies, should be considered for capitalization of the asset as PPE, as location and condition necessary for it to be capable of operating in the manner intended by the management. Then contention of querist is that CGI approval is a mandatory statutory requirement to be taken by the company before the constructed power inspection is connected to the grids. However, at times the CEIG has issued post-factor approval also. That is, the company has obtained the CEIG approval post connection of its power network to the grid. Hence, CGIG approval is an administrative procedure to be adopted before formal operation is conducted. So the query which was formally put up before the committee was query related to timing of capitalization of transmission asset and substation as an item of property, plant and equipment from capital work in progress in case of construction as well as in case of modernization. So the issue involved whether CEIG approval is a mandatory requirement or we would test the put to use criteria of the asset. So now I would request Madam Archana Bhutani to take up the issue and dwell upon the facts for the benefit of the members attending.
Thank you so much. But just for 2 minutes, if you can just put the first slide of the query, just for 2 minutes, if you can. So, but before I get into the technical aspects, let me just first of all thank by saying it's a pleasure to be part of this webinar. I've had a very good association with EAC in the past. I've been a special invitee, and there was a term when the past president, Mr. Mishra, was also the vice chair, and I've really enjoyed the discussions we've had in this committee. So it's a pleasure for me to be able to discuss some of the issues which have been recently finalized. The first one which has been taken, I think it's a very interesting issue. Now, the principles are frankly very simple. It's not that it's a very complex transaction, but when we were discussing, we thought it's a very relevant one because of the pervasiveness. The concepts involved in making the assessment are such that they would be relevant to a large number of transactions and probably therefore would also be helpful to a large number of members. I'm just going to, I know it's a complex matter in the transaction, the way the diagram's been put, but if I can just quickly kind of get you to think about this process in a very simple way. So you've got a process where material is coming in, materials gets tested. Then there is a pre-commissioning test which is happening by the company itself. So once that pre-commissioning test is approved, you've got an inspection by in a way an authority. That authority is effectively that inspection by CEIG here is more focused on the safety aspect, right? So think about it, you've got a pre-commissioning test, then an inspection to see safety, and then there is a test run which is done. Now, let's say you do a test run, you may identify issues, those will be sorted out, and test runs done. Then comes the fact that this substation and transmission line, somewhere it has to supply power to a electricity supply company. Now, the electricity supply company will then connect its line with this substation. So 3 or 4 key points: pre-commissioning, then approval by CEIG, then test runs. Then you've got the customer also looking at, after the test run, of course, you'll say it is anything which is any issue, it's sorted out. Then you've got the customer connecting, and you also have a commissioning, asset commission certificate by the company's engineer itself. Now, the question is, at what point of time do we say the asset is ready? And here I would like to, maybe now if you want, you can remove the slide. Here, I just want to take 2 concepts of the standard which are relevant. One is what goes into the cost of an asset, and the other is what is the point of recognition. I'm going to first talk about these 2 and then see the multiple additional points which come from here. Now, the standard says that the cost of an asset, it talks about the elements which will be its purchase price, cost directly attributable to bringing the asset to its use, and so on. So they will be there is specific provisions in the standard which talks about what all can the cost of an item of PPE will include. Now, till what time do you consider these costs and capitalize, right? So the recognition of cost in the carrying amount of a PPE will cease when the item is in the location and condition necessary for it to be capable of operating in the manner intended by the management. Now, many words here, but just focus on a few. It should be in the location and condition necessary for it to be capable. So the emphasis on capable. Is it capable of operating in the manner intended by the management? Once the test is met, you stop capitalizing the cost. Any cost incurred after that is not part of your item which is capitalized. Now, in the fact pattern that we discussed, the question is till what time do you take the costs into account? Does the asset become capable of operating in the manner intended by the management when the pre-commissioning test happens? Does it reach that condition when the CIG does an inspection? Is it at the time when test run is completed? At what time? Right? And there, I think the point which was made when the fact pattern was being described, is the standard focusing on put to use, or is the standard focusing on ready to use? So as you can see from what I explained, condition necessary for it to be capable of operating, which means obviously it is looking at whether the asset is ready. Whether it's been put to use doesn't matter. If it is ready, it is capable of operating in the manner intended, then you capitalize. Now, the contention, if you look at the contention of the company here, the company had 2 or 3 contention. The company said as far as the process is concerned, CIG approval, which is, the approval for safety, etc. They felt that is the key point. Once that approval is received, it will signify according to them or represent the point where the asset is capable of operating in the manner so intended. Let me just focus on this point first. Now, if you look at it, test run, if you ask me after the CIG approval, you are going to have test run and all those things. Test run, if you ask me, is very integral to how, to kind of looking at whether the asset is ready for its intended use, right? And therefore, while CIG approval may be one part, is it necessarily conclusive? And that is when you look at the EAC opinion. The EAC opinion is also saying that it requires judgment and requires knowledge, technological knowledge and judgment as far as the fact pattern is concerned to see when is the asset ready for use. And I'll come to this a little more in detail. The second contention is of the company was that as far as the substation is concerned, it cannot be used before the CIG approval. And that is why till the time that process is not completed, the intention of the management, the way the management intends to do is not met. And they also feel that till the time the customer line is not connected, they feel the asset cannot be used. These are 2 or 3 points I just wanted to highlight before we go into the key principles. So like I said, the standard is looking at when is it ready to be put to use. And in this case, while yes, you will apply judgment and so on, there could be many activities which could represent completion. Like I said, it requires technological assessment and judgment. And therefore, in this fact pattern, to say CIG approval is the sole determinant may not be really appropriate. Now, frankly, the EAC opinion doesn't go beyond that to kind of say in this fact pattern, which is the stage or which is the activity which really indicates, the capitalization point. Like I said, again, needs to be looked at in the context of fact pattern. But definitely in this case, given the fact that test runs were yet to be done, and then you may incur additional cost to rectify those errors, etc. To say that CIG is the sole determinant may not be appropriate. Now, you also need to consider, I also spoke about whether the asset is capable of operating in the manner intended by the management. So this intended use by the management also becomes relevant. If I can just digressing from this fact pattern, just for an example, I mean, if I was to, like I said, this is a much, much wider issue. Let's say I've got a hotel, and right now I've constructed the rooms, I'm letting out the rooms, but I also wanted to have a banquet hall. I also wanted to have some other facilities. Those are not available. Now, does it mean my asset is not ready for intended use? The fact is I've started letting out the rooms. I'm earning revenue. And maybe my rate would be lower because I don't have a banquet hall. But maybe once I have more facilities, I can charge a higher rate. So the question or the point I'm trying to make is that it becomes important to even identify what is the unit of account in this case. So if I've got a part which is ready, which can be used, it is independent and is ready for use on its own, then it would represent as if it's capable of operating in the manner intended by the management. To say, no, I would add on another aspect to it, and then the fact is the company is already operating it, and it is you are also earning revenue. So coming back to this fact pattern as well, in some of the, if you look at the entire query, there are certain instances where they've said, I do not have the line. The customer line has not been added, and therefore I believe it is not ready. The customer line being added is the fact that you finally started making the sale. The question is your asset ready? The asset is ready for its intended use, and therefore that is where you would not really go beyond that. Similarly, in some of the cases, you may have just the conceptual points that the EAC opinion brings out. It could be that your asset is ready, but let's say you've not started operating because raw material has not, the raw material is not available. Again, it doesn't matter. As long as your asset is ready for use, whether or not you put it to use would not impact the point of capitalization. Similarly, there could be abnormal delays, because of which the asset has not been put to use. So availability of raw material, inefficiencies, abnormal delay, these would not really impact. If the asset is ready for use, that is where the capitalization would stop. While describing the fact pattern, I had also mentioned about the test run. And I said test run is a very integral part. And if you'll see the costs which are usually capitalized, test run cost is a very, it's a very integral part of the, components of cost which is capitalized. Here, I just wanted to make one request. There is a tendency that for companies to say, I'm still in the test run. The test run phase for them never ends. They've started selling the goods. Like I said, they've started earning margins, but they will say, no, the quality is not what we want. Okay. Or it is not giving us the efficiency. It is not giving the return that we want. So it doesn't matter what the financial performance is. In a trial run or when a test run you're doing, what would be important is whether it is technologically and physically performing. Whether it gives you the return you expected does not, again, impact the capitalization point. So these are some of the principles which this EAC opinion actually reiterates. And then in this fact pattern, of course, the opinion says that the judgment would have to be applied, but definitely CEIG approval does not seem to be the sole determinant. Now, this could be a case wherein the substation was a new substation being constructed and the transmission line, they were newly being constructed. You could also, and the company also had situations where the existing ones were being modernized, right? So the question is, what do you do as far as something is being modernized? There again, the principles are similar. So you would add as far as modernization is concerned, you would again take elements which are enhancing the functionality or the ability of the asset to operate in that sense. So similar, in terms of the conceptual points that we discussed, they would apply equally, whether or not it is a new substation with transmission lines or whether it is a upgradation or modernization of an existing one. So just to kind of recap, the point of capitalization is a matter of technological assessment and judgment. Companies should exercise that judgment, keeping in view specific facts and circumstances. This will include technological parameters, safety parameters, approvals required from competent authorities, test run. In this case, I mentioned approval from competent authority. In this case, it was also mentioned that at times CEIG has given post facto approval. So in a way, while it is a relevant approval, it does not seem like so substantive that I can't really operate beyond. And in that context also, it kind of takes away the focus or the reason why we are saying this is a conclusive test. So that is one. And then again, just to reiterate, this I would really like to say, because we've seen practically instances where company starts using a plant. The machine is churning out goods. They may not be of the best quality that the company wanted. They are selling this. And this so-called is going on for a year. And according to the company, it is still test run. Now, if it was a test run, you would not be continuing for a year. So financial performance is not criteria. Technical and physical performance of the plant would be the criteria in terms of looking at capitalization. And last point, like I mentioned earlier, see whether an item is a part of a larger. So let's say if I'm setting up, so let's say 3 towers, and if I can use each tower on its own to transmit, right? Then it's an independent. It is capable of operating independently, and I will capitalize. But if this tower is part of a larger and integrated project, these 3 need to be necessarily connected, and one tower cannot work without the other, then you would not capitalize. Then you would look at it only once that asset is ready for it to be able to function. And that's why I said the unit of account, therefore, becomes very important. Non-availability of inputs or raw materials, abnormal delays doesn't really matter. And 2 more points, sorry, just here. I think here the depreciation also should actually begin when it is available for use. So the once you start, the capitalization point will also impact the point of your depreciation recognition. And let's say you've got a case wherein, the asset is taking, the construction is taking extended period, as in one of the cases in this fact pattern. Now, if something is getting, some delays were envisaged as part of your project plan, great. But if something is getting unnecessarily, these are abnormal extensions, you should also think about impairment. Is it such, why is this delay happening? Is it that I no longer expect this project to be viable? Is that why the company is going slow in the whole process of delay? Has some technology changed, etc.? So whenever there is an abnormal period of delay, just also see whether there is a trigger for impairment. These are some of the points, like I said, some very interesting points that this EAC opinion highlights. Sir, I'll request you also, in terms of any of these, would you like to add from your practical experience?
Yeah, thank you very much. And at the outset, I also express my gratitude and privilege to be a part of this particular webinar. And I am happy that we are taking up some issues which are of general interest to the members in practice as well as in company employment also. Now, insofar as this particular query is concerned, I don't have much to add except 2 things. The first is that, it has not been mentioned in the opinion as well. But in practice, we come across a term, commencement of commercial production, which is quite frequently used. Even today, it is frequently used. Earlier, of course, it was a part of the framework under which we were giving opinions, as there used to be a guidance note and things like that. But the point is that today also there are, some practitioners and companies, they feel that the capitalization of an asset should commence once there is commencement of commercial production. Now, there used to be issues on what is commercial production, as to whether, as Archana mentioned, that whether when the asset is ready for use, whether it is ready for commercial production also, or whether something more was required. And actually, some people used to argue that it is not only the technical completion of the asset to be operated in a functional manner that should be the test. But there should be some commercial production also, in the sense that you may be able to exploit that production may be a some number of units which you should be able to commercially sell in the market. So there was a focus even on the output also, to the extent that whether that output can be used commercially in the market. For example, if the output is, let's say 4 units, and you have to destroy those 4 units, or you have to keep those 4 units, you cannot sell it in the market, then the plant was not ready for commercial production. That used to be the argument. But here it would be noticed that Ind AS 16, on which this particular opinion is based, and the opinion which has been given by the expert advisory committee, they have not used this particular term of commencement of commercial production. Rather, the focus is on the test run. That is, if the test run gives you an answer which is, suitable, that the plant is ready to be operated in the manner intended by the management, then that test run is important. And actually, there is an explanation which is added to the aspect of the test run also, and that explanation is that the test run should, ensure that there is technical and physical performance. This term physical performance is of extreme importance, because here we are taking out the aspect of the commercial exploitation, that is some units to be sold, etc. It is only the aspect of technical and physical performance of the asset which should be in accordance with the desired manner intended by the management. That is of importance. So therefore, I thought that I would focus on this aspect, that it is purely the physical performance of the asset which was intended to be functional, which was intended to function in the manner intended by the management. So that is of importance. The second point which I would like to focus is on what Archana also mentioned, that in some cases the test run, we, in past also there have been some EAC queries which have come, that the test runs are prolonged, and it is argued that the physical performance is not physical performance of the product which is intended to be produced from that asset, is not up to the standard which was intended by the management when the production was started. For example, let us say the company intended that the product should be of quality A, whereas the actual production is quality B. And the management, they try to keep on changing the plant, changing the configuration of the plant, so that until the quality A is achieved, right? So that may take a long time. For example, if from quality B to quality A, the configuration of the plant is changed to such an extent that it is taking a long period of time. But in the meantime, the company is actually selling this product B, maybe at a lesser revenue, which it could have, generated out of selling product A, of quality A. So there, the question is, to what extent this test run can continue? Whether the test run is to continue until the quality which was intended by the management is complete, that is quality A. So in that particular case, it was about 2 years the plant was being operated, the test runs being done time and again, and the quality A was not being achieved, and the company was selling the product of quality B. So there, the EAC felt that there should be some limit up to which you can keep on saying that the plant is under test run. And therefore, if you are unable to achieve the quality of product A, in that situation, you should test it for impairment, that you may not be able to achieve quality A at all, and you will be able to sell quality B, which may be an indicator of the impairment of the asset as such, and that should be tested. So therefore, the test run, the nature of the test run, the period of the test run, and the purpose of the test run, they are of extreme importance before we decide as to when we should consider that the test run is complete to give us an answer that the asset is ready for use as intended by the management. I thought I will make these 2 points as to focus on the periodicity of the test run as well as the the quality of the test run. Thank you.
And sir, if I can just to continue, sorry, I'm going to request office will take a little more time on this because of the nature of this query, sir. I totally agree with what you said, and I think I did try and highlight that, and I'm only emphasizing it more. I think both the points you made are somewhere connected. Somewhere test run, how does it impact the ready to use, and therefore the commencement, the reference, like you said, no longer to the commencement of commercial production. Somewhere I feel these 2 points are linked. And I just want to take 1 or 2 more examples because I don't want the participants to just go back with this issue in the context of this fact pattern. It's a, given that it's a transmission substation, it is actually, you can have it in many, many transactions, like I said earlier. And I like some of the points you made. So there, I just wanted to highlight, if a company is doing a test run, let's say it intended a particular quality, right now it's an inferior quality, it is trying to improve and come to a better quality, it can still be a test run. I think the point which I was making, and Dr. Chandar also, is that when it is extended and you keep on selling it in commercial quantity, if let's say I'm really doing a test run, I would do a batch. I will see the quality of the batch. If that batch doesn't give me the quality I need, I would not continue producing and selling it. Then I would stop, I will tweak and make the changes. That can be a genuine case where the upgradation or the changes being made are still part of the test run. But let's say if it is you wanted an X quality, like Dr. Chandra said, and you are producing it at commercially viable quantity, you are selling it, like he said, for 2 years, etc. This is actually, you've gone into production, which whatever, now it is capable of working maybe at a lower, different quality product, but it is very much capable of, like you said, if you look at the physical and technologically, the capability, it is very much there. I also took the, let me also take again, these are some of the very actual ones. One was this, the other, let's say, you had a company had to, let's say, they were building a canal and it had to be of a particular height, let's say X. They had reached 80% of the X, 80% of that specified height. And that actually, I do not know when that difference will really be done. And it's just going on for years at that height. And they're saying this is still construction work in progress because I haven't reached the height that I wanted, the depth of that canal, right? Now, I think if it is a test run, then test run, it will never be such an extended one or a commercial kind of, transactions wherein you start doing it in batches. That's the point I wanted to make. And the other, which I'm now digressing a bit from the EAC opinion, and it just struck me when Dr. Chandra was talking. I think also just to take this opportunity to highlight the difference between now Ind AS and IFRS. In Ind AS, when you're looking at the test run, if let's say I've done a test run and there is some produce and I've sold that produce, the proceeds from that produce are netted off from the test run expenses and you capitalize net. Whereas now IFRS in IAS 16, they're saying now you do a split and you do not do the offsetting in that sense. So that there we have a carve out and we've not converged. So do you want to add on this? I thought I'll just mention.
Yeah, this is very important. I think this carve out which has recently come, and actually, under IFRS, IAS 16, this amendment has recently come, wherein as per the production during test run, if there is any income, it is recognized in the profit and loss. Whereas under the carve out, we continue with the earlier position that this income is adjusted against the cost and then it is capitalized as a part. In other words, the income is reduced from the cost of the asset as such.
And actually, if you ask me, the genesis of this, sir, also comes from the same issue of test runs, the way it was being abused, and the capitalization date was being extended. So therefore, they said you just kind of make that distinction. I think when we were looking at it in India, we said the issue is less about the presentation. The issue we thought was more about getting the point of capitalization right. And that is why we've not really, and of course, there would have been more practical challenges in terms of really splitting the cost and the revenue therefrom. But I just wanted to take the opportunity to highlight one, there is a carve out, and that carve out somewhere finds its root cause actually in the fact that the point of capitalization was actually, there were in many cases, it was seen that the date was just being deferred while the asset was ready for its intended use. Okay. So maybe we can go on to the next one.
Yeah.
Thank you, Archana ma'am and Avinash ji, for fantabulously deliberating upon such a issue. Now we would move on to a next issue, which is again a very interesting issue and which talks about capitalization of an assets as a tangible asset or an intangible asset. So the query is regarding classification of rail corridor assets in the books of accounts of a company as tangible or intangible assets, and then accordingly charging depreciation or amortization thereof. So now this query is for a company which had signed an MOU with the state government, SE Limited and I Limited to create a project specific special purpose vehicle in the state for developing the rail network for ensuring movement of coal. The company was incorporated as a special purpose vehicle under the joint venture model of public partnership policy of Ministry of Railways. These are some of the important terms which were there in the concession agreement. The part that I would like to highlight here is the objective was it was a BOT project basically, built, operate and maintain an approved rail system. The period of concession was 30 years, including construction period, which was extendable by 5 years. And also it had a clause that if the revenue has been achieved before, the contract period can be terminated 5 years earlier as well if the anticipated revenue is received. The revenue share arrangement was 50% freight to be collected by railways would be passed on with the concessionaire. The operation in the entire case was with the Ministry of Railways and Railways. Therefore, the operator was Railways. Supervision was through independent engineers and the maintenance was through other agencies. Now, going on further in the path, as I already told you, the target traffic was decided on the basis of net ton kilometer which was covered over the period of traffic. So that net NTKM which was decided during the concession period, there was a figure of 123,825.88 metric tons which was expected to be done. As I already told you, if it is done before that, then the concession period would fall short. And in case the traffic was falling short, then every 2% shortfall or part thereof, the concession period would increase by a period of 6 months. But in any case, it would not go beyond 5 years. So the original concession period was 30 years, and in case the revenue fell, then the concession period can at max be increased to 35 years. The company was entitled to receive 50% of the revenue apportionment from freight operator, that in this current system is railways, and from the entire operation of the relating concession. Now the next slide talks about the accounting policy of the company. Accounting policy of the company stated that the expenses incurred by the company on certain activities which are essential for construction, operation and maintenance of the rail system of the company are recognized as rail corridor. In the last deliberation of the matter, we have discussed regarding the concept of COD. So this time the company has also given us this concept of COD. After commercial operation date, including stage-wise commercial operation date, the assets are classified as rail corridor and depreciated based on the agreed targeted traffic based on the concession agreement. So you would note that here the company, what they are doing is they are capitalizing the asset, and based on agreed targeted traffic, they are putting the depreciation in that. Accordingly, rail corridor is being shown under the head of property, plant and equipment, and is being depreciated on the basis of progressive target traffic. During the audit, the auditor raised remarks on the creation of rail corridor asset and its method of depreciation. And as per the view of the auditor, this should be classified into separately identifiable assets. So, if you would look at the query stated that there are multiple assets which goes in the construction of the rail corridor asset. So they said that classifying the entire as one asset is incorrect. They should classify each asset as a separate asset, and then individual depreciation should be charged considering the useful life of the components there. The query was into three parts. First, the company asked whether it should continue the practice of classifying rail corridor under property, plant and equipment and the method of depreciation based on targeted traffic method over a period of license, or what the auditor suggested, whether they should classify the rail corridor into a separately identifiable asset and depreciate the individual separately identified asset considering the useful life of the asset. And third was entirely different. This was suggested by C and AG. They said that classify the rail corridor asset as right to use assets and classify it under intangible asset. Please note, company was currently doing it under tangible, and continue the depreciation of assets, which would be amortization since it is intangible, based on targeted traffic expected on rail system over a period of license. So these were the three questions that was put up, and now I would request Avinash sir to take up the query for the benefit of the attendees. Avinash sir, you are on mute. Can you please unmute yourself?
Yeah, sorry. Yeah, actually, it looks, keeping in view the facts of the case, a very complex query. But let us try to simplify it to focus on the key issues that are involved, so that we understand the type of the transaction which is sought to be covered in this particular opinion. Now, the first thing which I want to highlight is that here the transaction seems to be structured as a service concession arrangement as such, and the company and the auditor, the company is treating it as a tangible asset, as a rail corridor, showing it as a property, plant and equipment, charging depreciation thereon on the basis of the targeted traffic. And the auditor is telling that, look, it should not be a single rail corridor asset. And since there were multiple assets involved in the rail corridor, for example, there could be platforms, there could be track, and there could be signals. So therefore, you identify all these assets separately, capitalize them separately, and charge depreciation thereon separately, because the life of these assets could be different. And then the question which has been asked is whether it could be an intangible asset, right of use asset, or intangible asset. Now, as you would understand, the right of use asset is generally comes in the lease transaction. That is, in case of a lessee, when an asset is taken on lease, then there can be a right of use asset. And under service concession arrangements, there could be an intangible asset. So therefore, the committee's first, focus was on as to understanding what is the exact nature of the transaction, so that the right principles of accounting could be applied to that particular transaction. So therefore, the committee at the outset noted that it is being said that there is a build, operate, transfer type of an arrangement, and it has been termed as a service concession arrangement. So therefore, the committee decided to examine that whether Appendix B to Ind AS 115, revenue from contracts with customers, Appendix B relates to service concession arrangement accounting, which is corresponding to IFRIC 12 under IFRS, whether that particular Appendix B can be applied to this kind of a situation. So I would try to highlight that what is Appendix C and corresponding to the requirements of Appendix C, whether those can be applied to the facts of this particular case. Now, in Appendix D, the first thing is that typically the service concession arrangement is between a public and a private party. That is, there is a government or a government agency which is a grantor, and it enters into a PPP type of relationship with a private sector party who becomes an operator of that particular asset over a period of time till the concession period ends. So during the concession period, the operator operates the asset, and then the construction is also done by the operator, and at the end of the term, the asset is transferred back to the grantor. Now, in this particular case, the first question which the committee examined was that here the grantor was Ministry of Railways, and there is a Ministry of Railways which entered into an agreement with this SPV, and this SPV was also a government-owned company. It was not a private sector company. So the question which the committee examined that whether in this particular situation also the service concession arrangement Appendix B can be applied. So the committee noted that even though it is a government company which is acting as a kind of an operator, but still, since the focus of Appendix B is on provision of public service, and there was no there was no aspect as such as to who should operate, even though typically word was used that it is a private sector company. But still the committee felt that since the operator would be rendering the public service to the consumers of this particular rail track, so it would still be covered by this service concession arrangement. Because one could argue that it is a necessary requirement of Appendix B that there should be a private sector entity which should act as an operator. So the committee felt that even though it is a public sector company, it is a government-owned company, but still, since these rest of the requirements, which will come a little later, are also being met, then the service concession arrangement Appendix B can be applied. So having reached that conclusion, then there are other requirements of Appendix D which were required to be looked into. One was with regard to that, the question was that the grantor should control and regulate what services should be provided. Now here, it was very much apparent that the Ministry of Railway, who was the grantor, they were in a position to regulate and control as to what services were to be provided. The services to be provided were the trafficking of the coal from one place to another. The second was to whom these services are to be provided. So that was also very clear that these services were to be provided to the consumer, to the people who want to use that facility. And the third was at what price to be provided. Now here there was an issue because it, as you might have noted in the facts, that the railways themselves were the operators of the of this particular uh, service, which in other words, the railway line was to be operated by the railways themselves. So railways would charge the price from the consumer, and 50% of the revenue would be passed on to the operator. So the committee thought that since the railways would be operating this particular rail corridor, so they would be in a position to fix the prices, and then the 50% of the revenue would be passed on to the operator. So therefore, what price is to be provided, that is also in a way regulated by the Ministry of Railways as such, and therefore the grantor controls the price also. Then another aspect is of the requirement of Appendix B is that the grantor also controls the significant residual interest in the infrastructure at the end of the concession period. So here also that condition was also met, that after 30 years, which was the concession period, the company, that is the operator, would transfer that infrastructure to the railways. So therefore, the committee felt that all the conditions of the service concession arrangement were met, and therefore this transaction should be accounted for in accordance with Appendix D of Ind AS 115. So having reached that conclusion, the next question was as to how to account for any asset, the revenue, the asset which is arising from this particular transaction. Now, as you would recall, under Appendix D, there are two models for accounting for service concession arrangement. One model is called the financial asset model, and the other one is the intangible asset model. Now, under the financial asset model is applicable where the grantor unconditionally agrees to provide an amount of cash or another financial asset which is either determined in advance or determinable. So in this particular case, the committee noted that there was no such arrangement that the grantor would provide some cash or some other financial asset to the company, and therefore, and the revenue, the ultimate consideration from this particular transaction, that it depended upon the usage of the asset. And then the committee also noted there is one basis for conclusion of IFRIC 12, which the committee noted. This is BC 37. Actually, basis for conclusion are there in the IFRS. They are not there in the Ind AS. So for IFRIC 12, there is a basis for conclusion that in case the financial asset model is not applicable, then the grantor has to recognize it as an intangible asset. So the committee noted that since in this particular case, 50% of the revenue would be passed on to this operator by the grantor, it would amount to a variable use of the asset, and therefore the financial asset model could not be used, and you should apply the intangible asset model, recognize an intangible asset in accordance with the requirement of Appendix B. Now, actually, the committee did not go into the nitty-gritty of how the intangible asset amount should be worked out and things like that, because the opinion was more from the principal perspective. And it only said that you go to Appendix B of Ind AS 115 and then apply the intangible asset model, recognize an intangible asset and amortize the same. So here, the question, there is one peculiarity which is different from other types of service concession arrangement, which I thought I may point it out. For example, you have a toll road contract where there is a grantor and there is an operator. The operator charges the users of the toll road and then over a period of the concession periods, and then the toll road is recognized as an intangible asset if there is no financial asset coming from the grantor. Now, in other words, in the normal situation of a toll road transaction, the operator collects the toll fees directly from the ultimate consumer. And here, the situation was somewhat different, that the railways were operating the track and they were operating the track. Of course, there were, some operations which were done by the operator, like, maintenance of the, say, railway stations, the signals, etc. But the point is that the railways were sharing the revenue with the operator. So the question which the committee had to consider was that whether it could be considered as a typical service concession arrangement. So the committee felt that since the other requirements of the Ind AS 115 Appendix B were being met, that is, it is within the scope of Appendix B, then the question of how the revenue is being generated may not be of that consequence, and therefore the intangible asset intangible asset model can still be applied here, and the intangible asset should be recognized by the company in question. Then, the next question was how to amortize this intangible asset, because the company, as it has been stated, was recognizing on the basis of, they were amortizing the property, plant and equipment. It was not an intangible asset. They were amortizing the property, plant and equipment which they had recognized on the basis of the targeted traffic. So the question which the committee had to examine was as to whether the targeted traffic approach would be appropriate in the context of an intangible asset as well. So for this purpose, the committee then looked into the requirements of Ind AS 38, which is on intangible asset, on the amortization method, useful life, and things like that. So if we go into Ind AS 38, the committee noted that intangible asset can be amortized which has a definite life. Of course, in this particular case, the intangible asset has a definite life over the concession period or the targeted traffic, whichever is appropriate. So we'll come to that which is more appropriate in this particular case. But the point is that which particular method is appropriate in for this particular intangible asset. So under Ind AS 38, basically there are three types of amortization methods which could be applied. One is on the basis of time, that is over the concession period of 30 years. The other is on the basis of the unit of production method, that is the output produced from the use of the asset. And the third is the revenue-based model, that is based on the revenue as such. Now, in this particular case, the question was that, as it was shown in the facts of the case, there was a targeted traffic which was provided in the agreement itself. So the targeted traffic was, however, subject to change. I mean, the time period of the concession period was subject to change depending upon the targeted the traffic which is actually achieved. So, for instance, the that for every percent increase or decrease of 2% of the targeted profit, then the period of concession could be increased or decreased by 6 months. That was the provision in the facts of the case. But there was a cap and a floor on the uh, concession period. That is, it cannot be more than 5 years. It cannot be increased more than 5 years, and it cannot be less than 5 years. That is, overall, the concession period has to be between 25 years or 25 years and 35 years. It cannot be less than 25 years. It cannot be more than 35 years as per the terms of the arrangement. So in Ind AS 8, 38, if we look into the requirements of the standard, there the question is that what is the limiting factor which results in the consumption of the economic benefits of the intangible asset in question? That how does the intangible asset is consumed, whether it is consumed over a period of time or it is consumed linked to the traffic achieved, and what is the or it could be revenue also. For example, in some contracts, one could argue, I mean, there could be a provision that the concession period is limited to once. For example, if the revenue of say 1,000 crores is achieved, so the moment 1,000 crores of revenue is achieved, then the concession period is over. It could be 2 years, it could be 10 years, it could be 40 years, it could be 60 years. So in other words, the predominant factor there is the revenue. Now, in this particular case, the revenue model could not be used because here the only thing which was given was the target traffic. And there too, the target traffic, the target traffic was not structured in a way that, for example, if the target traffic is say 1 million metric ton, whenever it is achieved, the concession period is over. It was not like that. Because it could be say 1 million tons is achieved, let us say in 10 years, then the concession period is over in 10 years. It was not like that. Similarly, if the 1 million the traffic is achieved in say 50 years, then it could be 50 years. But it was not like that. There was a range of 25 years to 30 years. 25 to 35 years. So therefore, the committee held that the limiting factor in this case is still the time. And the time of the concession period is the limiting factor. So therefore, the targeted traffic method is not appropriate. It should be the concession period, which should be used as the amortization for the purpose of amortization, the useful life of the asset. Now here, another issue was that, what happens if there is a change in the period because of the change in the targeted traffic achieved. So there the committee noted that Ind AS 38 itself provides that this useful life can be reviewed at the end of the period. And here that the committee then provided that you keep on reviewing the targeted traffic, and if necessary, you change the useful life between the 25 years and 35 years, given the facts of the each particular instance. So that is what the committee decided. Then another aspect which the committee looked into was Schedule 2 to the Companies Act. Now, Schedule 2 to the Companies Act also provides for a revenue-based model for toll roads. So there, the question was that whether if the revenue-based model is provided in Schedule 2 and the targeted traffic is, you can say, a surrogate of a revenue model, then if it can be considered as a surrogate of revenue model, whether under the provisions of Schedule 2 to the Companies Act, the company could still use the targeted traffic as a surrogate of the revenue-based model. So the committee then looked into some guidance notes issued by the institute, like guidance note on accounting for depreciation, and there is a guidance note on Schedule 3 also. So the committee then noted that the wording of Schedule 2 is that the model which is given in Schedule 2 may be used. It is not that you have to use the revenue-based model. The wording is that it may be used. And the second thing which the guidance note had noted, that the Schedule 2 only provided for that revenue model for toll roads types of service concession arrangement. And since in this particular case, there was no toll road type of an arrangement, it is a different type of an arrangement. Therefore, the Schedule 2 is not applicable. And then you have to go to Ind AS 38 and provide the amortization as required by that particular standard. And as I mentioned there earlier also, that the committee felt that the appropriate amortization would be based on the time of the concession period as reviewed from period to period. So that was finally the opinion. And the last thing which I would like to mention, that the committee categorically stated that since the company is not using Appendix D to Ind AS 115, therefore there is an error. No, in many opinions you will find that the committee is silent as to whether it is an error or it is something else. But in this particular opinion, the committee has very categorically stated that it is an error and therefore it should be accounted for in accordance with Ind AS 8, wherein the prior period errors, the accounting for prior period errors has been provided for. So you have to do it on retrospective basis, prepare a third balance sheet. Of course, that is subject to Ind AS 8 requirements of impracticable. That if you can't do it, if it is impracticable to do it from retrospective basis, then you can do it from prospective, but then you will have to demonstrate that it is impracticable, and then you have to make certain disclosures also in this regard. So that is broadly the opinion in this particular case, and it is this opinion is highlights in a nutshell the situations in which the service concession arrangement can be used, which probably the company had not even looked into. So that is something which for the companies as well as the auditors, they have to keep in mind the nature of the transaction as to first decide what is the right principles of accounting as enshrined in the AS, they have to be applied. Thank you very much. And if there is anything which Archana wants to add, most welcome. Thank you.
So I'll be quick in the interest of time because I want us to cover at least two more. I'll be quick, but 2 points I wanted to make here. I think the takeaway, when you look at whether the asset from service concession is a financial asset, intangible asset, one key test which I've always found good in a substantive, you're exposed to demand risk, which is what you try to bring out. If I'm exposed to the demand risk, invariably there is a intangible asset. If it's a simple case, I've done the construction, I'm going to get money, but get it later. It's a financial asset. It's a typical case of deferred payment, But the minute you're exposed to any risk from the use of the asset, that asset may not generate revenue or may generate less than what you thought, etc., the demand risk, then it is, I would say it's a clear this thing towards at least an indicator of, very, very strong indicator of intangible. The other on this, the amortization bit, I think that's a very critical one. And I just wanted to highlight why. Just think about it. If I from the perspective of the companies who've been asking for revenue-based amortization, to some extent, it did come in Ind AS 38 and IS 38, but it's been a long ask. Because if effectively what happens is in the initial period, there is a gestation period, the project may not really pick up that well. The revenues, the revenues pick up gradually. But what happens is if you're doing a time-based amortization, your depreciation or amortization is still coming equally. In the initial years, what happens is your revenue is lower. You've still got the same depreciation or amortization that you would recognize in future years. So your profit there is pressure on the bottom line. And that is where the industry, from their perspective of a business, I'm just saying, when they look at it, they're saying that, fine, I know in the initial years, my traffic is going to be lower. It will take time. It will pick up. It could be for the toll road. It could be for some other asset as well, even a flyover, etc., or I even forget even just a road related. I'm just saying typically at times the asset takes time in attracting or getting the real traffic. But unfortunately, the way the requirements are, as Dr. Chandra explained, if I've got an asset, I mean, I actually, my depreciation is representing the consumption, how I have used that asset. If irrespective of how the traffic is, if my consumption of the asset is happening, unfortunately, whatever, I have to still recognize it. If it's a time-based, if I have, let's say, if under a contract I have a right, let's say I have a movie right and my right is for 5 years, lapse of time, it will go irrespective of what the pattern of revenue is. So I think the point that Dr. Chandra brought out was the limiting factor. Which is the limiting factor? Is time the limiting factor? Is revenue the limiting factor? Now, I found this very interesting because, frankly, many had tried to say, if I don't have a direct revenue target, traffic is an indirect revenue target. That is how they thought. They said traffic is equal to a particular revenue. So if I have my limiting factor as traffic, why can that not be seen as a surrogate of revenue? Now, in this fact pattern, it doesn't, because you're still exposed to demand risk. Like Dr. Chandra said, if it had said your period would increase, decrease to compensate you for a particular amount of revenue, then it would have been. Now, why is traffic not equal to revenue in this case is, see, one is, why did they include this clause of modification of the term? My sense is because it makes the whole project more viable. There is uncertainty of the traffic, and the minute you tell the contractor that yes, in case the traffic doesn't pick up, we'll give you a little more time so that you're able to recover your cost, right? To make it viable for the contractor. That is why these modifications are there. But despite this modification, I'm not guaranteed a revenue. Let's say it says for every 2%, less traffic than expected, you will get an extension of 6 months. But in that 6 months, how much traffic will be there? I still don't know. Despite that 6 months extension, I still don't get a guarantee of a particular revenue. So yes, somewhere, usually, intuitively, many tend to traffic is equal to revenue. Itna traffic hai, so I know this much revenue I'll get, and therefore this is a revenue based. It is not unless and until the modification was happening basis the revenue. It is happening basis the traffic. The extended time may still not guarantee you a particular revenue. But it's a very, very sensitive or a very critical point as far as service concession is concerned. And I understand where it is coming from, given the mismatch, at least in the initial years. So we move on to the next.
Thank you, Archana ma'am and Avinash ji, for dwelling upon such an important issue concerning Ind AS 115. There are two questions that some of the attendees have asked regarding the first opinion that we had taken. So, Archana ma'am, this is for you. First question is, I would read out the question. If a rectifiable error is seen during a test run, is it okay to capitalize the asset?
Okay. So let's say that when the way I've understood this, your technical error means obviously the machine, when you're constructing it, it's not working as it was intended and you're kind of truing it up. I would say, yes, it's a normal part of, as long as these are normal test runs, etc. Any modification that you're making for it to reach the kind of technical performance that you wanted would get covered, and you'll be able to capitalize that cost.
Okay, thank you. Next question
Sir,
again.
I would say, sir, feel free to add, sir. Dr. Chandar, if you have a different view, just feel free to add.
No. I think.
Yeah. Okay, let's move further.
Yeah, next question is, a government company has completed a building and put it to partial use, but not capitalized because it is not approved by CPWD. How to treat this item? Pretty similar to the query that we have taken up. So,
have used the building without CPWD approval. Is it an illegal thing, right? Now, if I presume I can do it, and probably then this is more administrative in nature, this is not really representative of any non-compliance. And if I'm fully, in the sense, I'm using it in the sense, whichever part I'm using, I'm making full use of it. You don't do a test run of a building. I don't know, how do you do a test run of a building? We're going to see how does it feel. So as far as the building is concerned, I would say, if, let's say the building I wanted to construct, let's say had 5 floors, was to have 5 floors, 2 are ready, and I've started work in those 2. My staff is coming, employees are there, I'm holding my meetings. I would stop capitalize. I would capitalize and not add on any further as far as concerned. Because otherwise there would be non-compliance.
okay, thank you. We would move on to the.
And frankly, I've actually seen instances where in a school, let's say it said I'm going to have class 1 to 5 or 1 to 10. They've already started doing classes 1 to 5, but they're still not capitalizing the school. They are having proper classes. So I think somewhere you need to see. Yeah.
Actually, this is a very common problem in government, where the CPWD is involved. Because for a long period of time, the certificate is awaited. So therefore, I have actually seen that many government companies, they don't capitalize until the CPWD gives the certificate and then it is considered. But to my mind, that is not correct. And companies on year round, they keep on that CWIP even if the asset is being used. But that is not correct.
Okay.
Right, we'll move on to query number 3. That is accounting treatment of assets funded by customer for its use in specific project. Now, this query again is a very tricky query because it covers Ind AS 18. So prior to introduction of Ind AS 115, there was Ind AS 18 which was there. So I would read out the facts of the case. A company is engaged in design, development, and manufacture of aircrafts, aero engines, aerospace structures for customers on contract basis, which involves a substantial period of time. The company entered into contract with government department for setting up of integrated cryogenic engines manufacturing facility at the company, which is termed as contract A, and for establishment of facilities for repair and overhaul of specific aircraft and its aggregate, which is termed as contract B. Now, the relevant information from the MOUs entered in the contract A and contract B is as under. Necessary facilities would be set up, augmented at the company, which shall be funded by the department on the land belonging to the company. As per contract A, the manufacturing facility shall be the property of the department. So department herein refers to the company who has given the contract, located at the company for long-term utilization of the above program and other elite future programs of the department, whereas contract B is silent on this. So contract A was pretty specific on the issue. On the other hand, contract B did not say anything on that. Under contract A, the company will be responsible for procurement and commissioning of machineries and setting up of facilities and shall be eligible for a specified percentage of facility cost as handling charges and a specified percentage profit margin on handling charges. Similarly, contract B provides for reimbursement of the total cost of project of establishment of facilities for repair and overhaul of specific aircraft, along with its aggregates including freight, insurance, storage space, and a specified percentage profit on non-recurring costs, etc. The company agrees to make available in its premises adequate space for the establishment of necessary building and facilities. So the queries involved were two. Number one, whether the company has control over the assets, since the company is at liberty to use these assets for other projects of the same customer till the end of the useful life of these assets. If not, whether the company should recognize the revenue towards non-cash consideration in the form of assets over the total duration of the project as and when the performance obligation is fulfilled. So I would request Archana ma'am to kindly dwell upon the issue.
Thank you. What I'm going to do is I'll try and cover this quickly. Frankly, I mean, I can go into more technical details, but that will take more time, and I would want us to discuss one more query. So I'll try and summarize the situation and the way the standard is looking at it. And if anybody wants more detail, then maybe in the Q&A, last Q&A, we can pick it up. Now, effectively here, if you see, you've got a situation wherein the customer is giving me money to create an asset, and that asset will be used for the execution of the contract. So the question is, who capitalizes this asset, first of all? And let me just also, mention that, usually situations wherein you've got assets which are funded by customer, I've seen this largely in the utility sector, but it can be in others also, but this is very, very common in utility sector. So let's say the customer says, I will give you money, you please create this asset because this asset I need to serve the customer. In the absence of that asset, I may tell the customer, listen, I'm not able to provide services to you. So it does happen, especially in utility industry, that the customer gives you this kind of an assistance. Now the question is, when you create this asset, who should capitalize this asset? Okay. Either I will capitalize or the customer will capitalize. Those are the only two options. Now, what is an asset? An asset is something from which you get future economic benefits. Very simple. I'm not getting into the nitty-gritties, but it is an asset from which you get economic benefits. Now, how would you get that economic benefits? You actually have economic benefits by directing the use of that. Yeah, and you direct the use and you get the benefit. That benefit can come to you. Like I said, you'll either use the asset or you will sell the asset. You can do many things. I mean, you can pledge it, you can sell it, you can use it to provide services. So effectively, largely, if I was to bucket it into, it's use or sale. That's how you get the benefit. And when I say use can be for services, use can be for pledging and so on. So the question is, who actually has control over this asset? And when I say control, like I said, I will see who can direct the use, who can benefit from this asset. Now, in this fact pattern, there are two contracts. In one contract, the customer has said, while giving the cash or funds, has said, I will be the legal owner of the assets that will be created from this. So just imagine I'm providing services. Land is mine. Land is mine. On that, some facility has to be created, and that facility will be used to manufacture products or units that the customer only will purchase. Now, the minute they say this facility is legally mine, which means I can neither use it for any other customer, I can't pledge it, I can't sell it, I don't have any right over it. So obviously you can't capitalize. It's a very simple thing like that, right? Now, let's say, what do you do? On day one, the customer gives you money. What would you do? Obviously, it's a liability because in return of that, you actually have to render something. You have to create an asset, and that asset will belong to the customer. So effectively, in this case, when I'm constructing an asset, which finally will be the asset of the customer, in a way, I'm providing a construction service and I've got the money in advance. So you've got that money, you'll recognize that liability. And as and when you provide services, revenue will get recognized as per 115. Now in this, I'm first going to take the first case only and the second will become easier. Now, like I said, I'm going to construct that asset, and then there I will also manufacture parts which the customer will buy. Should I recognize revenue separately for sale of parts? Should I, and separately for construction, or should I look at the two together? There again, you apply the principles of whether it's a single performance obligation or multiple performance obligation. In this fact pattern, it seems to be separate because one is not dependent on the other. So, but principally, I am saying take away the principle from here, see whether it is a single performance obligation or multiple. Here, if it is multiple, then what you would do is you will recognize revenue from the construction separate, and you would recognize revenue from the sale of parts separate. And then for construction, if you were to apply Ind AS 115, effectively you will fall into percentage of completion method. I mean, I'm presuming usually it does, but you can also obviously in some have completed contract. But in this fact pattern, it largely, I think, qualified for percentage completion. But you apply the principles of revenue recognition, which is at a point of time or over time, you will apply to both of these two separately in this fact pattern, because these are two separate performance obligations. Now comes the second contract. In the second contract, somewhat similar, but the customer never said that the asset will belong legally to me. See, control, the way control is defined in Ind AS 115 is wider. Legal ownership is one, but it's a very strong indicator of control. You can have who has physical ownership, who has risk and rewards, etc. You look at many, many factors. The standard provides those to see who controls it. Now, when I said I did talk about what is an asset earlier, I said an asset is something that for which you can direct the use and get the benefit. That's how you control, right? You direct the use and get the benefit. Now, directing the use and getting the benefit can be, one is a very direct way. The other is if I can restrict someone from using it, that is also an indicator of control. So let's say there's a park. I can use it, of course, but if I can restrict others from using it and say only I will use, nobody else can use, that goes to show I am controlling that park. So same here in the second contract. While the customer never said they legally own it, they said that you will not be able to use this premises for any other customer. You can use it for other orders of, of the same party, the party which is giving the funds. You can use it for more projects of mine. If I'm the customer, I'm saying you can use it for more projects which I will give you, but you can't use it for any other customer. So in a way, the customer which gave the funds has restricted the right of the company to use that asset. The company cannot use it. It has no ability to take any decision to direct the use or use it for any other customer in that context. And therefore, even it will fail the test of an asset which is controlled by the company. In the query which was received by the EAC, the company was capitalizing this, whereas actually, because there is capitalized. So in one, the legal ownership was there. In the second, while the legal ownership was not directly referred to, there was restriction. So the point I'm trying to make is that you get funds. Now, actually, if you look at 115 actually, Ind AS 115 deals more directly, the literature, if I was to come to the literature, it deals more directly with cases where I get a non-cash asset rather than fund. It deals with a case where the customer is saying, listen, I'm giving you a non-cash asset. Maybe I'm giving you land. Now you construct something on it, or I'm giving you whatever, something. But here they were giving me funds, not a non-cash consideration. But the principles, frankly, would be similarly applicable. So even though I got cash rather than a non-cash considerations, you'll apply the principles of Ind AS 115. See who controls. Like I said, controls is directing use, who has a benefit, etc. They are indicators in the standard. If you don't control, don't capitalize. Then comes the next bit, revenue. Like I mentioned, see whether there is one performance obligation or multiple. For each performance obligation, apply the principles of 115 as to whether the revenue will be at a point of time or over time. So broadly, if you ask me, that is what I would say the opinion kind of highlights, and very interesting, very common, like I said, in the utility industry. So any key point if I've missed? I know I've kept it brief, but I thought maybe if we can quickly touch another one, but any key point if I've missed?
No, I think you have touched all the points. And I think the key point is deciding who controls the asset. and where you have to look into the facts and circumstances of the case. So I would therefore like only to emphasize that in such situation, the facts and circumstances of establishing a control over the asset are very important, and then they may differ from case to case, and this particular opinion should not be used, you can say, a generalized opinion that in all cases it would result into similar results. Thank you.
Yeah. And I'm not getting into that nitty-gritty, but there is also an additional question which comes up is that but I've anyway discussed on the revenue bit because it will be over time. It may not be immediate. I just wanted to kind of reiterate. And at times, there could be more complex arrangement in terms of how the adjustment may happen through the sale price of the goods being sold and so on. But I'm not getting into it. Like Dr. Chandra said, there could be more nuances of each such contract, some other complexities, but just keep in mind the broader principle. Yeah.
Thank you, Madam and Avinash ji, for dwelling upon such an important issue in such a lucid way. It really, I would say, would help the attendees in solving their queries regarding Ind AS 115, considered to be one of the most typical Ind ASs. Moving on, we have now query for in the cash flow statement. So it is regarding classification of business activity as operating activity or investing activity for presentation in the statement of cash flows. So I would read out the facts of the case. A company is a non-banking financial company, infrastructure finance company. The company has three types of transaction investments. The brief details of the same are as follows. First is investment in special government securities. As per the scheme under which the company operates, it cannot undertake any investment activities. The company parks its surplus funds in special securities which are not transferable, and conversion in any other form of security is not permitted. Considering the fact that the company cannot undertake the investment activities and park the surplus funds in government securities, which is the part of the primary operations of the company, the subscription of special GOI securities considered as operating activity. So basically, this is the present treatment which has been done by the company. Second transaction is sale of marketable government securities other than special government securities. Now these surplus funds are invested in marketable government securities and or certificates of deposit, FDs, and in AAA rated PSU corporate bonds. The proceeds from maturity of any government security are treated as operating activity of the company. Third transaction is equity infusion in the wholly owned subsidiary ABC UK Limited. ABC UK Limited, a 100% wholly owned subsidiary of the company, was incorporated to lend to Indian companies implementing infrastructure projects in India or to co-finance their external commercial borrowings for such projects solely for the capital expenditures outside India. The company's equity investment is treated as part of operating activity in the cash flow statement, considering it as an integral part of an operation to fund infrastructure loan. So basically, all the three transactions have been shown under operating activity. There has been questions raised by the auditors, statutory auditors and the CAG on the particular issue, and therefore the opinion was made to EAC, and the query which was made to EAC was whether classification of the investment, redemption of government securities and equity investment in the cash flow statement for the company is appropriate or not. So meaning thereby to say if they have classified the matter in the operating activity, whether it is correct or not. So now I would request Dr. Avinash ji to kindly take up the issue.
Yeah, thank you. And as the time left with us is not much, so therefore I would simply concentrate on the principal point which have been raised. That is whether these three types of securities which are mentioned in the query, whether they should be treated as operating activities as such. Now, the first type of, the government security, which are the special securities. And with regard to the securities, in other words, the cash flows from investments in Ind AS 7, basically, there could be, three types of investment. One is those investments which are cash equivalent, and therefore they would be treated as cash equivalent, and accordingly, whatever is the treatment for cash equivalent, we will do that treatment for cash equivalent. The second type of securities are those securities in which you are trading or dealing in those securities. In other words, where these securities are in a way the trading stock, or you are trading in these securities. So naturally, if you are a trader in securities, it would become an operating activity, and any cash flows from sale or purchase of such trading securities would be recognized as an operating activity. And the third type of investments are those investments which you have invested for a long period of time, and the return which you are getting, the interest or dividend, that is your principal revenue, and therefore the interested revenue could be the principal revenue in case of an NBFC, because here the company in question is an NBFC. So that could be considered as an operating activity. However, the sale or purchase of investment is more like, sale or purchase of a plant machinery in case of a manufacturing company. So therefore, these types of sale or purchase of these types of investment would be an investment activity as such. Now, applying these principles to the facts in question, that is the government securities which are of special type, the committee noted that these are long-term investments. And the committee also noted from the balance sheet of the company that these investments are measured at amortized cost, which means that they are not measured at fair value. I mean, FVTPL, that is fair value to profit and loss, which would indicate that these are trading securities. So since they are long-term securities, the committee decided that sale or purchase of these securities, cash flow would be investment activity and not an operating activity. With regard to the marketable securities, the redemption amount received on the redemption of the marketable securities, which were also government securities, the committee did not give a very definitive answer. The committee said that you look whether these marketable securities you had kept it for trading purposes, and if you have kept it for trading purposes, then the revenue which you are getting, I mean the cash which you are getting from redemption of these securities, then you recognize these as revenue, I mean the operating activity. But if in case these are also kept for long-term purposes, then the redemption or the sale of such securities would also be an investment activity. And the third type is the equity infusion in a subsidiary. So there the committee held that since it is an equity investment in a subsidiary, therefore it should be considered as an investment activity. So therefore, in two cases, the committee was very categorical that it should be investment activity. In one case, depending upon the marketable government security being held for trading, or otherwise it would be operating or investing activity. So that is broadly, the opinion of the committee. And apparently, it seems, since from the facts of the case, it was mentioned that the company is prohibited from making any investment. So possibly the company was interested not to show it as an investment activity, but to show it as an operating activity. But here I may point it out that simply because a company is prohibited from investing, the fact that these are being classified as investment activity would not preclude that there is a violation of any, term which has been specified for the purpose of the operations of the company. So broadly, I would then summarize. In summary, that is the opinion of the committee. Insofar as this part is concerned, it was not a very complex issue, and the committee therefore gave a very short opinion as such. Thank you. Archana, if you want to add anything.
No, sir, I think I
Archana,
would
ma'am, you are on mute.
audience to have the chance, though you're aware of my little dilemma on this, that one leg of the transaction is sitting in investing and the other is sitting in operating. But yeah, that is yeah. But let's just open it to questions. Yeah.
Now, at this stage, I would also like to welcome CA Piyush Shajarji, our Central Council member and Vice Chairman of this Expert Advisory Committee. So, if anyone has any questions, so we have around another 5 minutes, so you can just type in your chat box or you can just send us the queries. So, we have our eminent panelists available with us, Dr. Avinash ji and Archana ma'am. They can answer your queries if you have any.
Generally, it would not come in that chat box. The Zoom link is directly going live. It is live because they are not part of this. Am I right, Arun?
Okay, so we have one query. This is regarding query number 1 that we have taken, Archana ma'am. So the query reads as under: ready for use asset is from accounting standards, but tax allows put to use. So how can we harmoniously construct this aspect of capitalization?
So I don't know, when you say harmonious, because if the two are different, the point of sorry, there's a.
No, you can go ahead, ma'am. That's fine.
I'm just saying, if the two laws here, you would go by the accounting principles, not by the tax principles. The tax principles are different in so many other aspects as well. You've got your own tax or accounting standards, plus there could be other, certain expenses you would, which let's say 43B, which they're not allowable, you still recognize, right, in your financial statements. So the two are very different. I think it would be a very easy life if your financial statements for tax and accounting were just identical. But so.
And typically, this is the reason why there is a difference. There is a concept of.
Sorry, yeah.
Yeah, that just to add on to what you were saying, this is the reason why there is a concept of permanent difference and temporary difference, and it leads to the creation of deferred tax assets and liabilities.
So obviously, we don't have this permanent difference in Ind AS, but you're right, that is where temporary difference comes into this thing. But I mean, see, effectively your tax base may differ because what you're capitalizing there and what you're capitalizing here. In fact, the definition of cost is also different. If I'm correct, I'm not a tax person, sorry. But what is cost under Ind AS 16 and what are the elements of cost under the Income Tax Act itself can be different. And there are differences to my knowledge. So the fact is, yes, these are two different. As far as the capitalization bit is concerned, I'm expecting that if you do not have an abnormal delay, usually you would have a very small gap between ready to use and put to use, and that should not really lead to a material difference. But this would become a key point only for whatever reason. I've got the asset ready, the customers, I've not been able to, enter into contracts, or because of some legal reason, because I'm not able to get started, right? But otherwise, if I've undertaken a project, think about it, I'm investing money. Somewhere I would have some pipeline of customers, and hopefully, if there are no impairment indicators, etc., the ready to use and put to use should normally, in a business scenario, should not be too much of a gap. That's what I would think here. I think it's just that, frankly, the case we were trying to cover is that when you say it's ready to use or put to use, you stop capitalizing. Whereas what is practically a challenge is that they are shifting the point of recognition beyond even putting to use. It's being put to use, forget ready to use. In the example that we discussed of the building you took, the building is being used. Forget ready to use. It is being used and you're still not capitalizing. So that issue is slightly different. The focus of that EAC opinion is on, elements. When do you stop capitalizing, and therefore the cost that would go. I don't think practically in a good project, it should be that big an issue. But of course, if there are abnormal delays, etc., business challenges, economic conditions, yes, of course, you could have a big difference between the two. So do you want to add anything?
No, I think that's okay.
Raghavendra, you are mute.
Mute, still mute.
Raghavendra, you will have to unmute. No.
Am I audible?
No, please go ahead.
Okay, so now I would request Piyush sir to formally give a vote of thanks for the event. We don't see any more questions. So
Yes.
I request Piyush sir to go ahead with the formal vote of thanks.
Thank you very much, CA Dr. Raghavendra Goyal, for moderating this wonderful session. My thanks to Dr. Avinash Chandar and Archana Bhutani also. And to all the participants who have been joined online, who are watching live on YouTube also. As you all know, this is our second round for this particular calendar year, this fiscal year, which we call in the Institute of Chartered Accountants of India. This is the second webinar wherein we have been able to discuss opinions which have been issued by EAC with very good faculties like Avinash and Archana this time. So the idea behind this webinar was to discuss the intricacies and what was the thought process when the opinions actually were drafted. That's more important. If you really will feel, when I actually read an opinion, sometimes I also do feel why such an opinion has come, because it actually challenges your thought process or your belief. But when you actually read, listen to these experts who were actually involved also at some point of time, maybe not in this opinion, but they have been involved in the EAC committee discussions, you will realize why such opinion was taken, and it will help you largely while deciding such an issues if it comes up to you. If you, my one request to all the participants would be, now once you would have read this opinion earlier, there may be some doubts. Now you read the opinion again after listening to the experts. I'm sure it will actually clarify much further. You will actually come to know why the thought process and why it was written. It's like that if I'm actually studying an opinion, then I listen to the experts. That's a logic behind why such a opinion came in. And then again read it. I think so it helps you a lot. And that's what the idea behind such an webinars is. The importance of this opinion is it is as good as a regulatory function, as I think so in the opening remarks also my chairman would have said. It's one of the oldest committee of the Institute of Chartered Accountants of India. And our opinions are very sought out. A lot of the corporates look towards our opinion, what would be opinion, and they are actually worried. You won't believe at the EAC, once a query is raised, they keep on doing follow-up with us, that what would be opinion. They are really worried because they know an opinion in a particular manner can actually change the they were actually practicing the accounting treatment, whatever accounting treatment, and therefore its importance is that. If an EAC opinion is given, it is also very difficult for anybody, even for companies or for the auditors, to disregard it or follow a different treatment, and therefore it has a very strong regulatory backing to it. So very much thank you all the participants, and please look forward to this space. We'll try to keep on doing such more programs. The idea behind is, though you may be, because generally they are on Ind AS. I know a lot of participants would not be actually involved in Ind AS also. You may be only applying accounting standards. You may not have come across such Ind AS standards, but it is not important what the theory is all about. It is the thought process which needs to be understood. What was the thought process which has gone behind these opinions? And which I believe, if we have speakers like Avinash and Archana and moderation done by Goel, I'm sure those thought processes have been cleared today very much as far as those Ind AS is concerned, those issues are concerned. So please keep watching this space, please keep joining it. I'm sure though Ind AS may not be applicable to you, AS may be applicable, but you would be much better off while you are actually applying those accounting standards or Ind AS, maybe any other Ind AS which has not been discussed. I think so you would be doing much better, you would be much enlightened to it. So thank you very much. Once again, a great thank you to Avinash ji for giving the time. which you have been always available to us for the EAC EAC Opinions. So all the participants, for the benefit of you, Avinash ji, at this age, at this time also, he was in London, but he has never missed any expert advisory committee. And he involves himself into a line-by-line chair-by discussions. And at the committee, we look forward to his opinion without his taking an opinion, whether it's, he may be in the favor of whole the committee, or the committee may have a different view, but his thought process, his comments will be always there. And without that, we cannot go ahead. Similarly, Archana ji, obviously, now you are not in EAC, but I know you have been in EAC, you have been contributed a lot, but your contribution to AASB continues. So, of course, you are experts on this Ind AS, and therefore it's very important that we have contributed to you. And thank you very much for that also. Goel, obviously, you are part of Expert Advisory Committee. Thank you very much for taking this and moderating a wonderful session, especially moderating superb, eminent panelists today. Thank you very much, all of you. Thank you, all the participants. So I'll end for the day. Tech team, you can stop the recording and we can close for the day.
Thank you.
Thank you, sir. Thank you.
Recording stopped.